When it comes to analyzing the market, there are two primary approaches: fundamental analysis and technical analysis. This can be a controversial topic in the Forex community, as some people claim that one approach is more important than the other. Let's take a closer look at each type of analysis. Fundamental analysis involves studying economic data, news headlines, and other factors to determine the strength of a country's currency. This includes elements such as monetary policy, retail sales, unemployment rate, inflation, gross domestic product or GDP, interest rates, and others. While fundamental analysis can be very useful, it can also be quite complex and require a deep understanding of macroeconomics and geopolitical events. Additionally, the software and sources of information needed for this type of analysis can be expensive and out of reach for many retail traders. At Neo Trading Club, we use technical analysis to study price action. Technical analysis involves using historical prices to analyze the current movement of a currency. The main idea behind technical analysis is that history repeats itself, and the same is true for market movements. We like to say that technical analysis is the mirror of fundamental analysis. Whatever is happening in relation to news and the economical data of a country's currency is instantly printed in the charts. As technical traders, our goal is not to predict the market, but rather to gather clues from the charts based on past events in order to forecast possible movements in price. A trader is like a weatherman. For example, you can have super expensive tools that help you to predict if it's going to rain, or you can simply create some mechanical ways to forecast the weather, like looking at clouds, noticing the changes in wind direction, etc. And guess what? Both the weatherman with all the high-end equipment and you with your own creative techniques can be wrong many times. We don't need to be right 100% of the time to keep our job, and in our case, to potentially make a lot of money. While we primarily rely on technical analysis, it's important to be aware of major events that may impact the market. These events, known as high-impact news, can bring volatility and uncertainty to the market. Since we trade based on highly probable events, we avoid trading around high-impact news, as it can be risky and lead to slippage. And just as FYI, slippage simply means that your broker won't fill your order at the price you wanted because of the volatility of the market. So some examples of high impact news include CPI news, the Consumer Price Index, unemployment rate releases or NFP, which is the non-farm payrolls, and political speeches. You can find more information about these events on websites like forexfactory.com or TradingView. Both websites have calendars that can be filtered by currency pair and type of event. As you start getting more familiar with the strategies, you will start switching how you view the charts to look at them like the professionals do. To understand this concept better, think of the charts as a game of chess. As you become more skilled at the game and start to recognize patterns, you will be able to play both sides of the board. Instead of trying to predict what the market will do, you will react to each scenario as it happens in real time. This means that you are not biased toward any particular direction, but rather you are simply looking at what the market's next move might be. To reach this level, it's important to study technical analysis, but also understand a trader's mindset. One great resource to understand the uniqueness of the market is to read the book Trading in the Zone. It will help you shift your mindset to this more experienced approach.